for your time. I hope you learned something. What are the top 3 things? Save more. How much you're going to put in? You're going to put in pre-tax or Roth, and then he's going to talk about where you're going to invest it. Okay?
All right. So the technology is amazing with this website, and there was just a brief glimpse of it. I mentioned this last year for those of you that remember, but Empower Retirement is the 2nd largest record keeper of 401ks in the country, and so Apple is one of their keynote accounts, and they collaborated with their IT department to help bring this type of technology so that you all have access to it. So their benefit was everybody's gain, and I would encourage you to play around with the site. You can't hurt anything, and it just gets you more in tune with a little bit of the plan. So we're going to jump into a little bit of a different conversation now that we've gotten some of this housekeeping of the 401k. You got mobile apps, you got all kinds of tools, calculators, educational resources, the ability to navigate through your screens on the website to effectively make a change if need be. That's basically where it's done. So my role, we're going to talk a little bit about the markets. As an advisor, there's a lot of really important topics out there. We can talk about Social Security, we can talk about budgeting, we can talk about college planning, we can talk about how much do you have to save in order to have a decent, respectable retirement. We can talk about spend down strategies of how much can I take out every year, all kinds of different things. But watching the news the last couple of weeks and months, we're going to talk about the market. So bear with me as I go through some of these slides. That I think the burning question in this room, most of you, if you're going to watch a little bit of Fox or CNBC or NBC, any of the networks for the most part, you're hearing a lot of news about the economy. You're seeing big jumps in the market, big drops in the market. So we call that volatility. And I want to address some of that. I want to at least wrap this up and put it into a little box and put a bow on that thing so that you can have some different perspective on this whole thing. I'll skip through some of these slides. Before I dive into the market, there's a couple of screens that I want to kind of prep you on, just to set a level of expectation. I know we've talked a lot about saving, but just to put some math around it in basically a bar chart. This individual investor A started saving at age 23 and saved for 10 years and basically just put away $5,500 a year. So maybe they made 55 grand and set aside 10%. The total amount invested was just under 50 grand. And in this example, something happened where they just stopped. In this scenario, they just stopped saving. But because of compounding annual rates of return on your money and the fact that they had 30 years of this time to do so, almost grew to $1 million. Some of you might be like Investor B, where you started it, didn't do anything between ages 22 and 32. Maybe you went to school, college, had student loans, got married, just couldn't save, got a job, and started saving in your 401k or whatever savings vehicle. Still did the $5,500 a year, but had to do so for 34 years. So that's 3 times the length of time. Actually wound up with a little bit less money. So this is really a great example of the power of time for all of you that are in this room that are a little younger. Obviously, Investor C is where we would all like to be, just pretty much steadfast from age 23 all the way to age 65, and stuck away that $5,500 a year, can wind up with a little less than $2 million. So that's where we all want to be. So again, to set a level of expectation, when you save for retirement, depending on where your age is, it's a journey, right? It's not something that happens overnight. You don't see tons of results, even from year to year. You have to be steadfast with this whole stuff for a long period of time for it to amount up to anything. So here's a checkpoint chart, and what this is really designed to do is to figure out what sort of retirement savings you should be at based on just some national averages. So if you have a combined household income of anything that's up here, let's concentrate more on this 100,000. So maybe you and a spouse both make 50, or maybe it's 125, and let's say you're 40. So these multipliers are what you should have already saved up in some sort of a investment vehicle, whether it's your 401k or IRAs or outside accounts. So for easy math, 100,000. If you're 45, you should have about 300 saved up somewhere. So that's how you use this chart. I didn't mention that this PowerPoint presentation is going to be sent out to you, so don't worry so much about taking notes. We'll send it out to you so you have these screenshots. It'll be a PDF that you'll easily be able to reference. So again, just a real simple checkpoint slide here on where you should be at in your life. So again, just another slide before I dive into charts. Wants and needs. We covered a little bit of this with Michelle's conversation, but we have to be very, very careful that you understand what your needs are. Your needs are, you have to be able to live and work. And so when you see house payment, rent, car insurance, taxes, transportation, gas, electricity, food savings, these are necessities that you need to sustain yourself. Food, water, shelter, right? So make sure that you have a great understanding between what you're spending your money on from day to day, week to week, month to month, and what these needs are and what wants are. Wants are compulsive. It's online purchases, travel, entertainment, concerts, dining, clothes, gym, and, well, you gotta have some clothes, but not maybe designer clothes. Coffee, drinks, we pick on that a lot. So keep in mind that when you're spending money to differentiate your wants and needs, and go back to that whole budgeting tool that's available on your website, or create one. There's lots of different apps like Mint and there's a couple really good phone apps that you can use to actually queue up your bank account to keep track of budgeting on your phone, and it tells you when you've gone over on certain things. They're pretty cool apps that are out there. Except when you sign up for some of those, they'll send you a lot of junk. You've kind of given your rights away to for them to market to other companies. Just this year, so 2019, me personally, changed my car insurance, changed my homeowner's insurance. I called Verizon, got a lower rate with unlimited data, and was able to save money in all three categories. It takes a little time, but sometimes saving money is hard to do, but sometimes just saving money on bills a different way equates to income, right? So I don't know how often you guys do this, but if you've not looked at your cable bill, you've not looked at your phone bill, you haven't taken your car insurance to bid, you haven't taken your homeowners to bid, things that you get billed for, question these things. Why am I paying what I'm paying, and is there something better out there? If there was a takeaway today where you guys could potentially save hundreds, if not a few $1,000s between now and next year this time, do that. Take the time to call these providers and ask if there's any sort of a better rate, a special discount. If you have to change carriers, change carriers. Don't be married to them unless it's your uncle that sells insurance for State Farm or something like that. But it's good to check your bills and make sure you're getting the best value for your hard-earned dollars. All right, I'm going to skip through these slides because we covered a lot of that in the last presentation. All right, here we go. We're going to dive into Finance 101. And you guys can handle this because you're a smart group and you're great savers. But I really want to wrap up what I believe is happening in the economy. So the first thing I want to show you is just a basic overall look. This is a chart on the S&P 500, and this is August 2nd, 2019. This is not old data. We're talking less than a month old. And what this shows is where the S&P level is when you hear it on the news. The index is from 1996 all the way to basically a few weeks ago. So you can see that we had great run up in the late 90s. We had the tech bubble when the market dropped in 02. We call that the tech bubble. And then we had a nice little run up to our Great Recession, which was in 08. The markets dropped considerably back that time. We all remember that, right? That was what, 10 years ago. We were all around. Most of us were working, and the housing market bust, and it was just a miserable time to live through. Minus 57% on the drop there. And then really, essentially, since 2008, the longest bull run in market history ever, since the markets opened well over 100 years ago. Not to say that we don't have drops, because you can see the dips. Does anybody remember checking their 401k statement on December 31st, year end? Do you guys see that? It was terrible. We had this nice run up in all of last year, and then all of a sudden, the last 8 weeks of the year, it just plummeted. And it was horrible. Because all you remember is what you saw in 12/31. That was just a line in the sand balance of my 401k, and it dropped, right? We all remember the bads, we never remember the good. But obviously, since then, we've had a great run-up. We've had a fantastic year, So markets go up and down. Understood, right? We got that. And the burning question is when's this going to end? When is this going to look like that? Those drops. When is this next recession going to happen? So here's my prediction. In the news, two topics: China trade. That's front center. Everybody knows that. We're hearing that literally every single newscast and what's going on with that. That type of market gyrations is caused a lot by that because nobody knows what to do with that whole thing and how it's going to turn out. The second big topic is the inverted yield curve. Does anybody even recall any of this happening last week where the 2 and the 10-year yield curves were inverted, right? So what does that mean? If you buy bonds are kind of this level of safe investing. The longer term of the bond, 10-year, 15-year, 20-year, 30-year bond, the more time you're exposed to, you get paid more for that. Makes sense, right? I got more exposure in time, I get more for the return of that bond. A 2-year should not pay more than a 10. That doesn't make any sense. We call that an inversion when that happens. The yield curve pays you more for the 2 than it does the 10. So what does this chart mean? Wow, there's lots of lines, there's little red dots, there's little green dots. All of these gray bars are recessions going back from 1962. So what does this chart tell me? Well, one, we have recessions, right? They occur. We know there's one maybe out here somewhere. There's another gray bar that's going to be posted in the future somewhere. All of these green dots predicted a recession when that yield curve inverted. So right now, this was a green dot in 08, or actually it was 06, and then there's a little bit of time involved before the actual recession. So over the last 3 weeks, this little blue line went right here on that flat bar and the yield curve inverted. So what that means is that sometime, on an average in 14 months, we most likely are going to have another recession in our country if you just left this for what it's worth. That was the only predictor. Now, you can argue a whole bunch of different points. This is just one piece of information. But the fact that it's been over 10 years since we've had one, it's normal business cycles that this country does have a recession. It might be, well, according to average, it's 14 months. So we're a year out, right? So that's my big prediction. So next year, when I come back, who knows what it's going to look like? I might be wrong, but based on what I'm seeing, we're probably going to have a recession in 12 to 18 months, maybe 2 years, is what I'm guessing. So what do you do in your 401k? So that's a big question that every one of you has to answer, because my recommendation is that if you're younger, you're not going to do a darn thing. You're going to keep putting money into your 401k plan, and as the market goes ups and downs, you're going to see 4 or 5 of these recessions in your lifetime. You're just going to keep plugging away. Even in your 30s, maybe even in your 40s, maybe stay moderately aggressive. If you want to try to scale back on your risk tolerance, you can do so. I'll show you a couple of slides where I can become of help there in a minute. I would say the only time you really want to be super sensitive to what I'm just telling you is if you're probably in your mid-50s or 58, 60, 62, and you've got less time to work. Now, if you're going to work till you're 70, that's still a 15-year horizon. You're going to weather through this with no problem. Your risk tolerance is your key barometer for that, and your time in the workforce. Those are the two things you have to be real careful of. One other chart that I want to show you, again, lots of different things to look at here, but let me simplify this for you. This is the PE ratios. What PE ratios are is the price-earnings ratio. So stocks have a price-earnings ratio. You can look them up on Google Finance, Yahoo Finance. And what this chart is telling me is that our current PE ratio is 16.68. We don't want the market to be overpriced, right? Nobody wants to buy stock in Coke if it's overpriced. You want to buy low and sell high, right? So who's going to buy stocks if everything's overpriced? So PE ratios are a combination of how things are priced in the market. And right now, we're not overpriced. So this leads me to think that the economy still has room to grow. So as we talk about a yield inversion, we talk about recession, it's not going to happen right away. It's not like tomorrow there's going to be a recession. It's a light switch. It doesn't happen that way. You start to get mixed signals. Housing starts to slow. Inventories start to build. Things happen where, interest rates are fluctuating, and pretty soon, all of a sudden you find yourself in a recession, but it happens over months. And because price-earnings ratios are fairly acceptable, I'm saying you should have confidence as investors for at least another solid year. I really do. And I say that even though the market dropped 600 points on Friday, it went up 200 points yesterday, we're seeing these wild 1+ point swings in the markets, and you're hearing all this news. Try to not pay too much attention to that day to day and look things at a more broader scope, and try to stay a little bit less emotionally engaged with what you're hearing on the news. It is important. I want you to pay attention, but I don't want you to make any crazy investment decisions on your 401k based on what you're saying and say, pull everything to cash. And because you're a doomsdayer by mentality and you're just thinking the market's going to crap out and you want to keep what you got. I would not do that. And I'll show you a chart as to why. Any questions at all on maybe my message on what I'm trying to convey here so far? All right, let's talk about this year. Again, you're going to get this, but I'm going to point out these numbers because they're too hard to read. Year-to-date 2019, these are different market sectors. This first one is real estate. You have a real estate account in your 401k, by the way. It's doing well. I never put allocations in there, not because I don't like it. I just think if you own a house, that's kind of your real estate exposure in my world. So 21%, large cap is at 18%, small cap mutual funds are at 14%. Allocation, this box here is basically a 65-35 split. You can see there's kind of a general average there. 11.5, good. Domestic equities, 11. High yield bonds, 10%. Amazing. Who would ever thought bonds would pay you 10%? Intermediate bonds at 7, 6% on emerging markets, 2% commodities, 1.5% cash. So it doesn't matter where you put money this year. You made money. You made money. If you look at your year-to-date earnings in your 401ks, you're going to range anywhere from probably 8 all the way up to 16. Some of you probably averaging right around 14-15% rate of return this year in your 401k. It's January 1, even with the drops in this last couple of weeks. So you've all done well. You've done twice as good as the market averages over the years. It's been fantastic. So applaud those wins, and it's great to see all that. So anybody seen this asset allocation guide before? I've got a bunch up here. I send it out once a quarter, I promise. Every quarter, every 3 months I send this out. Here's what it's designed to do for you. All of these investments that are available in your 401k plan are listed right here. Some of you, if you want to use my help and suggestion, this is my allocation guide. This is all the research that I look, read, see, and hear, and try and stay in front of when I put these ticker symbols into my software and I look at all the data on each one of these mutual funds. Then I put this together, right? So this one's dated August of 19, so it's the newest one. There will be one in October, one in January, and one in April. So if you want to follow this investment advice, here's what you have to do. This is not automatic. I can't do this for you. So you have to log into your account like Michelle told you to do, and there's a little tab on the side that says change my investments. So you have to drive the bus. You have to go in and physically, if you're a moderate investor, if you're a moderately aggressive investor, or just simply aggressive, you have to type these numbers in and hit submit. We showed you how to change your deferral rates from like 6 to 8 or 8 to 10. You can also change your investments. Hardly anybody does. And if you want to follow this guide, I would encourage you. I think it's going to be great advice, and I think it puts you in front of the best performers that we have in our plan, given the market circumstance. So again, this particular menu has got all different types of, there's bonds, there's short, long-term, there's high yields, there's real estate, there's foreign investments, there's small caps, there's mid caps, there's large caps. So we have literally the Applebee's of menu of mutual fund choices for you. So if you want hamburgers, you got hamburgers. If you want salad, you got salad. It's on the menu for you, right? That's my job as an advisor, is to make sure that there's something for everybody. And then it's also to make sure that it's the best of the best. So any guess as to how many mutual funds out there have ticker symbols on the New York Stock Exchange? You say a wild guess. I asked this last year. If anybody can remember. Roughly about 22,000. There's 22,000 mutual funds out there that you can buy. We get 20. So who put those 20 there? Well, it's the investment committee at Yamato. largely the software that I run behind the scenes when you guys are working with all your products out there and in sales and in administration and all that stuff. I'm busy looking at these sticker symbols, making sure that what you have to pick from is the best out there, so that you can be in front of the best performers that are available. And then on top of that, I even say, this is what I would do if I were you. So this is how you use that guide. You just have to put it to use by logging in. Any questions at all on this? Yep.
Particularly in light of the potential recession.
Yep.
Is there a precious metals choice?
So they're
not commodities.
It's
just
not
precious metals.
There is not. And so here's the reason why. So there's lots of different ways to invest money. So commodities, I hate to show you this, commodities is a great hedge against market drops, right? Because it's uncorrelated with the markets. Commodities have been literally like in the tank for the last 20 years. Now, granted, it's going to be good to hedge against, a recession of sorts. What I would recommend is if you wanted any sort of protection at all, this cash account is 1.5%. You'll probably do better in a guaranteed account than you would in commodities, is my guess. Because to try to,
but leading up to a recession, gold, for instance, is.
Yeah. So again, if we put a commodities mutual fund in the 401k plan, and it typically underperforms over the long term. These are all long-term investments. I don't want the company to be exposed to a poor performing mutual fund and have a lawsuit because I put that in front of them, or we put that mutual fund in front of them, and it just continually is lost. Now, it may do good in the next year, but to put a mutual fund in there for a year and then take it out and try to time that, it's just not something the 401k typically is responsible for. I would say own gold outside of your 401k plan, or move into more of a conservative approach and hedge against the recession with bonds and in cash, if that would be the style. It probably will not be commodities. Okay, plan to stay invested. I show this slide every year because I think it's that important, and we're coming up at the top of the hour here. So if you invest $10,000 in January of 1997, and you left it there for 20 years, your average market return is just short of 8%. You can see the value there, it's around 42 grand. We're talking about market drops, basically. So what happens if you try to time the markets? If you miss the 10 best days in the markets over the course of 20 years, so these are 10 big days in the market. So there's 5,000 plus trading days. You miss 10, you cut your rate of return in half. If you happen to have missed 20 by trying to time the markets, you cut it in half again. So for those of you that have time to weather through this recession, again, I strongly recommend that you don't yank out of everything on any sort of moderately aggressive or aggressive nature if you're younger, and try to time this thing. Because if you miss the rebounds, you're just going to kill yourself. You're better off weathering through, and even if you're getting paid in a recession, you're buying at all these low points, right? So you want to buy when the market's deflated. That's the perfect time to buy. Warren Buffett had that figured out, didn't he? So 6 of the 10 best days occurred within 2 weeks of the 10 worst. So sometimes when we have a bad day like Friday, down 600, you have a Monday up 260. Do you want to try to time that and miss that Monday? It'd be great to miss the Friday, but who's gonna know? Yes, Sharon.
What's your definition of somebody who has time to weather out the recession?
If you have time to weather out the recession, stay steadfast in your discipline. If your discipline right now is moderately conservative with 65% stocks, 35% bonds, stay there. Just stay there.
But who's somebody who doesn't have time? That's
if somebody who doesn't have time, we should already be looking at I would say,
who is that?
So weathering through recessions last a couple of years, right? I don't believe that this next recession is going to be as long in duration. It's not going to be as deep as 2008, right? Shorter in time, shallower in depth. If you're 58, you're gonna be working, that puts you to 62 at the latest. I mean, we're gonna rebound from all of this stuff. You're still gonna be fine. The whole idea is that, so here's another answer. General rule of thumb, take the number 100 minus your age. That should be your stock bond allocation. If you're 60 years old, you should be 40% stocks, 60% bonds. If you're 20 years old, you should be 80% stocks, 20% bonds. The number 100 minus your age is your stock bond allocation. That's a general rule of thumb. So a 60-40 portfolio, puts you kind of like right in the middle right here. You still potentially work 5 to 7 years, maybe even 10. Does this recession of 24 months, a year from now, make any sense? It does make sense. We want to keep what we have. The most I would recommend is jumping over, maybe if you're moderately aggressive, you can come down maybe a couple columns. Even our retired people have at least 35% exposure in stocks. People that are in their 70s have 30% exposure in stocks. You never want to give up stocks altogether, because otherwise you don't have much growth. So, especially if you live till 90, that's another 15, 20 years for some people. You have to have some stock exposure. Does that make sense? There's a lot there. I don't want this recession to scare you. I want to see you stay disciplined in your approach. And we're a solid year away from any of this anyway. This isn't tomorrow. We're talking a year from now before some of this stuff happens. And I could be even wrong with that, right? Election next November. We're all going to vote. Will it affect the economy? Absolutely it will. I think whoever gets elected, I don't think that the economy is going to waver from whether it's going to go into a recession or not. I think the business economic cycle is going to happen on its own. Whoever inherits the presidency is going to wind up with whatever the market's going to do. We're in a world economy. If you see, I don't want to be political here. So if the White House changes, Trump's not reelected, and Democrats change the tax law from what it was back in January when the tax cuts came out and the corporate tax rates went down to 21, I think that will enhance the ability for the country to go into recession quicker, because anytime taxes go up, that's never good, right? So that's just one comment. Now, obviously, there's lots of other political issues, but as far as the economy goes, I believe the tax cuts of January of 19 need to stay in effect. I think that needs to be left alone in order for some of this resilience to kind of keep going forward, if we're talking just economy. So, all right, so my time's up. I'm 5 minutes over. Hopefully this is helpful. I want to give you the best economic advice I can, and to put you in front of the best performers that I can, so that your experience in your 401k is enhanced as best as possible. Phone and email, call me anytime. Always available to help you out, and many of you have called. You're saving wonderfully. 92% participation rate in this company. That means very few of you are not. You're already automatically enrolled. But if you're saving at 5, bump it up. Can't stress enough how much you need to save. Corey, do you want to add anything at all?
No, I think you did a great job. I think you covered everything.
All right, good.
I did forget to pass around this sheet. If anybody is interested in having somebody help them roll their money over, in the past it used to be a real pain, right? We'd have like 9, 10 pages they had to fill out.